After a strong rally in January, oil quotes entered this month with a slight decline, having retreated from early highs. The price of oil is hovering near $90 per barrel. Analysts are sure that oil will eventually head for the target of $100 per barrel. It's still supported by strong bullish factors such as the looming energy deficit and the policy of the OPEC+. On February the 2nd, the cartel members will meet to discuss its plans for the output. Most likely, the current pace of oil production will remain unchanged. Besides, some members are expected to lag behind the compliance rate. In the light of current geopolitical tensions, decreasing crude stockpiles, and the lack of new coronavirus restrictions, the imbalance in the market may persist at least until spring. Therefore, the bullish outlook for oil is still relevant. Let's look at the technical picture on oil. Brent oil futures have been actively traded recently. After reaching a new local high, the price started a correction and lost about 3%. Analysts consider this a short-term decline and predict a further uptrend. At the moment, the market sentiment seems to be changing, which may result in a spike of speculative activity on the asset. In the meantime, the Russian currency is regaining ground against the US dollar. The fundamental background favors the recovery of the ruble. However, it is still too early to talk about an improvement until political tensions between Russia and Ukraine ease. But since there are no new rounds of escalation, the ruble has slightly stabilized. As the two countries seem to be looking for a diplomatic outcome, the correction on the pair will stay relevant. In the near term, the ruble may get support from the Central Bank of Russia, which is expected to announce its decision on the key rate in mid-February. Yet we should keep in mind that today the ruble versus the dollar pair is mainly driven by the geopolitical factor, so the situation may change at any moment amid the risks of new sanctions against Russia. As for the trajectory of the pair, it's still going through a technical correction. The pair has depreciated by as much as 3 rubles and is likely to decline further as the ruble strengthens. The reason behind this is the overbought status of the US dollar, which hit record highs at the end of January. Therefore, the quote is expected to move towards 76 rubles per dollar, given that the news background remains positive. Gold has finally reversed to the upside, but is mainly driven by technical factors. The oversold status of the asset resulted in a technical correction. Unfortunately, this growth may be short-lived, as it seems that markets no longer see the precious metal as a safe haven asset. Today, the quote may slightly recover, but it's still dependent on the policy of central banks. This week, the European Central Bank is expected to announce its decision on monetary policy. Until then, gold is unlikely to develop a strong trend. As for the technical scenario, gold futures have completed their downward rally. The plunge ended at the level of $1,780 per troy ounce, from where the price pulled back later. Amid the current decline of 4%, this recovery is not enough to balance the oversold status of the asset. Today, gold is expected to continue its upward movement. We hope that our video review will help you evaluate the current situation in the market and bring you gains. Trade wisely and stay with us. See you back soon.